And you know what's the cherry on the top? The company holds a lot of assets on its books. If I simply look at the balance sheet, the fixed asset portion of the on books is a total of 4,200 crores, out of which as of March 2023, 1,800 crore was investment in land and 1,400 crores was investment in buildings, a combine of 3,200 crores. Hi everyone, good evening. Today let's do another stock review. Today we will discuss a company called Jain Irrigation. Now it's again a turnaround story. It was in financial difficulties till about 4 years back, and post that it entered into a restructuring plan with banks and has been executing the same ever since. Jain Irrigation is the second largest micro irrigation company globally and the largest manufacturer of micro irrigation systems in India and the USA. It is also the largest manufacturer of mango pulp, puree and concentrate in the world, and the third largest manufacturer of dehydrated onions. It is also India's largest manufacturer of polyethylene pipes, one of the 3 leading PVC pipe manufacturers, and it is also the world's largest manufacturer of tissue culture banana plants. Wow! Why it went into bankruptcy or into financial difficulties is essentially due to its EPC or project business, which was a drain on its working capital, and then that drain on working capital combined with the corona impact and the rest of the business cycles meant that the company was unable to honor its dues. So why did this company, which was in financial stress, come onto my radar? One, the fundamentals are very good. The company is available at a price to book of 0.7. Its market cap today is close to 3,800. Its operating profit margin today stands at about 11%. A profit after tax looks negative, but it is turning around as such. The debt on the books is 3,900 crores in total, which is as of 31st March balance sheet. As of today, it is closer to 2,900 crores. The company has repaid a certain amount of debt during the last 9 months. And out of this 2,900 crores, also about 850 crore is the unsustainable portion of the debt, which was a part of the overall restructuring plan, which was converted into 0.01% coupon bearing NCDs. Now, if we look at the sales growth numbers, the company has really flatlined in the last 10 years. In fact, last 5 and 3 year sales growth is negative 6% and negative 1% compounded growth, but the trailing 12-month growth has been encouraging at a positive 15%. Similarly, the ROE, return on equity numbers, has been negligible for the past 10 years combined, but for the last 1 year it has been at 19%. A company which has just turned profitable, where we don't know whether it will sustain or not, and there is every chance that it will get into losses again. So what made me like this company? A few things. Mostly its credit rating was the starting point, and then the investor con call which the company did with its investors after the December 23 quarter results. Those are the 2 things which really helped me make up my mind in terms of the possibilities of this company being a multi-bagger for you and for me. So let's quickly have a look at both. Let's first have a look at the credit rating. The credit rating is a very recent one, 24th March 2024 credit rating by CRISIL. The credit rating now is at BBB minus with total bank facilities rated of 2,730 crores. First, BBB minus is just about the bottom of the investment grade credit rating, and for a company which was in default till about 3 years back, to come back to this rating shows the inherent. Jain Irrigation Systems Limited has implemented several policy changes over the past 18 to 24 months to reduce receivables. The company has stopped taking new EPC projects across all segments in September 2019 and will complete majority of the ongoing projects by fiscal 2025 with a delay of 9 to 12 months in the original plan. Also, the company implemented cash and carry model for sales to dealers as well as fixed a credit limit for each state for its subsidy business. CRISIL Ratings notes that at standalone level, receivables fell to 196 days for the first 9 months of fiscal 2024 from 370 days in 2021. So that's a very, very good sign and will come down further with better collection efficiency of existing business and collection of overdue receivables. The total debt outstanding was 2,934 crores as on 31st December 2023, including debt at Gen Irrigation Systems Limited India and the international plastics business. Of this, unsustainable debt was 854 crores, which was converted into a 0.01% NCD to be paid in bullet at a later date. Revenue grew 27% on year in fiscal 23 and 14% in the first 9 months of fiscal 24, driven by strong double-digit growth in domestic plastic business. Also, the operating margin grew to around 13% in the first 9 months of fiscal 2024 and is expected to sustain at 12 to 13% over the medium term. So essentially, we have 3 engines going on here. 1, the debt is now reducing at a very decent pace. 2, the sales have started growing again. And 3, the margins have started improving. Of course, the rating also gives a few more points. One was the fact that the existing stakeholders are infusing money. They infused 136 crores equity in June-July 2023, followed by another 50 crore infusion in November of 2023. And they are planning to infuse a further 150 crores by May of 2025 as per the same rating report. Now, when a promoter starts investing in its company, that is a sign of confidence. Also, as per the rating report, a DSCR of the company is expected to be at 1.3 to 1.4 times in fiscal 24 and fiscal 25. That means it will have enough liquidity to cover its loan obligations and hence the probability of default is less. Of course, a higher DSCR of 2 or more will be very, very good, but even a DSCR of 1.3 and 1.4 to a company which was defaulting in 2019 is pretty decent. So this is what the rating report tells me. Now let's come to what the conference call which the company did along with the investor presentation in December of 2023 reveals. Few selected portions I will point out, and most of them are related to the company's expected debt repayment schedule and how it plans to become debt free in the next 2 to 3 years. Now sales have been improving over the past year or so. EBITDA margins have been improving from 10% to closer to 13%. So at 7,000 crore and 13% EBITDA margin, it will mean that it will have an EBITDA of somewhere around 850-900 crores. Of this, they have a total debt outstanding today as per the credit rating of 2,900 crores. Out of this 2,900 crores, also 1,500 crore is working capital with no principal repayment and 1,500 crore remains term loans. Even if it is unable to monetize some of its assets or it is unable to collect old receivables, still it will be in a position to repay all its term loans in the next 2.5, 3 years. That will leave the company with only working capital debt of 1,500 crores, operating margin of let's say 800-900 crore annually, assuming no growth in sales and no improvement in margins, will still leave it with a healthy 550-600 crore cash accrual every year after paying interest on the working capital limits, which can be used for either reinvesting in working capital or that can be alternatively used for further capex. So a company with 550 crore of expected free cash flow in 3 years time, historically it has traded at a P of 30, but let's even consider a much smaller P of 15. Then also its market cap at 550 crore of free cash flow and 15 PE will work out to close to 8,000 crore at that time. Today, its market cap is 3,800 crore. If it achieves a PE of 30 again, then sky's the limit. But PE of 30 will also depend on growth, on a lot of other factors, which we don't know will happen or not. And you know what's the cherry on the top? The company holds a lot of assets on its books. If I simply look at the balance sheet, the fixed asset portion of the on books is a total of 4,200 crores, out of which as of March 2023, 1,800 crore was investment in land and 1,400 crores was investment in buildings. A combine of 3,200 crores was invested in land and building as of March 2023. This land investment is carried forward at book value, and hence the market value is expected to be more. How much more, I do not know. But even if we consider this at book value of 3,200 crores, then the company is available for a market cap which is slightly above the holdings of land and building on its books, or maybe at par if we consider the market value. The rest of the business comes free with it. As usual, it's a turnaround story. There can be a lot of challenges and issues which may crop up. It may not be able to execute. The overall industry may change. The larger macroeconomic scenario may change. There might be some strong competitor which may emerge from somewhere in the world. So there are a lot of issues, but the way I see this is the company is reducing debt, the company is increasing its sales, the company is increasing its margins, and it looks like it will be sustainable at least for the next 3 to 4 years. If all this combined together, I'm sure it will turn into the multi-bagger that we all want it to be. I personally hold some money in the stock, but I would request you as a viewer to do your own due diligence and not depend on this video as your only and only research video. This is not a stock recommendation to buy. This is my view on the stock and why I invested in the stock. So it's a no-brainer. I personally believe the company will execute from whatever little market sources I have. It's on the right path. The conference calls and the quarterly results tell me that the company is moving in the right direction. Whether it will achieve it or not, I do not know. But my belief is that the probability, the chances of it succeeding in its endeavor of becoming debt-free in 3 years is very, very high. With this, I will end this video. Until next video, happy investing.